Okay, let's dive right into this explainer. We're going to see exactly how the IRS is actually offering you a raise through their 2026 contribution limit increases. It's so easy to look at tax code updates and see absolutely nothing but confusing jargon. But hidden inside these announcements are powerful, completely legal tools to build your wealth and protect your health.
Seriously, are you leaving tax-free money on the table? Every single year, the government adjusts what you are allowed to save in tax-advantaged accounts. If you just ignore these shifts, well, inflation eats your wealth while you miss out on government-sanctioned tax shelters. So today, we're solving the dual problem of high taxes and escalating medical costs.
Here's our roadmap for today. First, we'll maximize your tax advantages. Second, the 2026 retirement limit boosts. Third, mastering the Roth account. Fourth, hacking your healthcare costs. And fifth, building your financial action plan.
Let's jump into Section 1, maximize your tax advantages using the two pillars framework.
I like to think of the complex tax code as just two distinct pillars of wealth building. Pillar 1 secures your future income through retirement accounts. Think your 401k, IRA, and Roth. Pillar 2 protects your current and future health through accounts like HSAs and FSAs. It's that simple. Master these two pillars, and you master your entire tax strategy. Moving right along to Section 2, the 2026 retirement limit boosts. Let's break down those new IRS numbers. For 2026, the base limits for your 401ks and IRAs have taken a pretty significant jump. For your 401k, the base limit is climbing from $23,500 up to $24,500. That is an extra $1,000 you can shelter from taxes. For your IRA, the limit moves from $7,000 to $7,500. It's a direct, totally measurable increase in your wealth building capacity.
Now here's where it gets really good. If you are 50 or older, you unlock a brand new $8,000 catch-up allowance. That pushes your total potential 401k contribution to a massive $32,500 each and every year starting in 2026. Basically, the IRS recognizes that as you get closer to retirement, you need to accelerate your savings to really sprint toward that finish line.
But wait, there is a super specific and honestly kind of surprising nuance here from the Secure 2.0 Act. If you fall exactly into the 60 to 63 age bracket in 2026, your catch-up contribution is even higher. It jumps to $11,250. This is a highly targeted super catch-up window that you absolutely must take advantage of if you qualify.
Okay, Section 3, mastering the Roth account and decoding designated Roth contributions.
The contrast here is actually super straightforward. Traditional accounts defer your taxes, but designated Roth accounts tax you upfront. You pay the taxes today, but the magic happens later. All the growth, all the gains, all the compounding interest is completely tax-free when you finally take it out. It's a real game changer.
Now, to actually unlock those tax-free earnings, the good stuff, you have to hit two exact steps. Step 1, the money must sit in the account for a 5 taxable year period. Step 2, you must be at least age 59 and a half or qualify through disability. Hit those two specific steps and the IRS cannot touch a single cent of your earnings. No way.
You really need to be certain about your strategy up front, though. The IRS has a vital caveat here. Your decision to designate a contribution as Roth is entirely irrevocable, meaning no takebacks. You cannot change your mind later and ask for the upfront tax deduction instead. Once it's a Roth contribution, it is locked in as a Roth contribution for good.
That brings us to Section 4, hacking your healthcare costs. We're officially crossing over to Pillar 2.
So the absolute crown jewel of the second pillar is the Health Savings Account, or HSA. But there's a gatekeeper. You cannot access an HSA unless you are covered by a high-deductible health plan, or HDHP. With this plan, you pay lower monthly premiums but have a higher deductible. If you've got this plan, you are perfectly cleared to open an HSA.
And for 2026, the tax-deductible contribution limits are frankly massive. If you have self-only coverage, you can put away up to $4,400. Covering your family? That jumps to $8,750. This is the ultimate triple tax advantage, folks. Contributions are tax-deductible, they grow tax-free, and they come out tax-free for qualified medical expenses.
And just like with the retirement pillar, the IRS is throwing in an additional catch-up contribution here. It's an extra $1,000 if you're age 55 or older. That pushes your self-only limit to $5,400 and your family limit to a fantastic $9,750. So what can you actually buy with all this tax-free money? Well, the IRS recently expanded the list of preventative items you can purchase tax-free even before you hit your deductible. Your HSA can now pay for telehealth, over-the-counter contraceptives, continuous glucose monitors, and more. They are treating all of this as preventative care.
Now, if you don't have a high-deductible health plan, don't worry, you aren't completely left out. You can still leverage a Health Flexible Spending Arrangement, or FSA. For 2025, you can voluntarily reduce your salary by up to $3,300 to fund your FSA tax-free. Just remember, FSAs are generally use it or lose it, although some employer plans will let you carry over up to $660 into the next year.
Finally, Section 5, your financial action plan. It's time to put those two pillars to work. Because, let's be real, knowledge is just potential power until you actually apply it to your paycheck. With these increased 2026 limits, the IRS has effectively handed you the blueprint for a tax-advantaged raise. So the question isn't just whether you're going to log in and optimize your deductions tomorrow. The real question is, are you going to let the government dictate your financial future, or are you going to use their own rulebook to build an absolute tax-free fortress? The next move is entirely up to you.